Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson, and joining the show today is Brett Siglin, a real estate capital markets business attorney at Jennings Strauss. He joins us today from Phoenix, Arizona. Brett, great to see you. Welcome to the show.
Great to see you too, Jimmy, and I'm so glad to be a part of this today.
Oh, fantastic. Great to hear that. Brett, you and I interacted at the OZ Expo in Phoenix, just a couple blocks from your office back in early October. You and I both served on the legislative panel, the first morning panel at that OZ Expo, along with Reed Thomas from JTC Americas, Shay Hawkins from the Opportunity Funds Association, and formerly out of Senator Tim Scott's office, was also on the panel. And of course, Dan Kowalski, formerly with the Treasury Department. And he was the one who essentially wrote the regulations for Opportunity Zones. What were some of your key takeaways from the legislative panel at that event that you and I served on, Brett?
Yeah, I think one of the first takeaways was I don't think anybody knows whether or when. Certainly, I think the legislation will pass, but we don't know necessarily when. So it could be in the next month or two, or it could creep into next year. And that was kind of an interesting takeaway. I think either way, everyone agreed that this is a necessary pending change. The 4 or 5 things that came up, obviously, whether or not to introduce more reporting requirements. That was something that I found really interesting. And we talked at length about whether and how that will impact sponsors and others out there. I think one of the takeaways is that it's probably going to affect smaller funds, smaller sponsors, maybe more than others. I think some of the larger funds out there are probably kind of ready for those reporting requirements to be enacted.
Now, a lot of them are already collecting a lot of the reporting data that they're expecting they may need in 2023 and beyond, right?
Yeah, agreed. And I think, it's interesting, at the outset of this 5 years ago, everybody expected there to be, reporting requirements. And I think just because of, the nature of the legislation that was passed in the Tax Cuts Jobs Act in 2017, there was a cost to imposing reporting requirements, so that was dropped. But I think everybody's kind of geared and ready for that. One of the other takeaways, though, for me, I think is, there's already been a lot of mistakes made, if you will, in the industry just in the first few years. And I don't know that this has gotten that much publicity yet, but we've had 3 years of practice now, and there's been a lot of mistakes sort of, with the 8609 filings and the 8996 filings, and then, also the investor filings on their tax returns. And we've seen, the IRS come back and issue letters to fund sponsors that, they had made mistakes on their 8996 filing. And there's been, several hundred of those this year. And my concern is that going forward, as we see more and more tax returns from, say, the 2021 tax year compared to 2019, 2020, there was exponentially more activity. There's probably more people out there making mistakes on those forms, or maybe their accountants were making mistakes. And I'm concerned about what that does to the industry. And then, sort of the uptick in audits at the IRS. And so, one of the things that this pending legislation does is it not only reinstates those reporting requirements, but it also imposes pretty strict penalties for failure to report. So I think that's something that, a lot of folks in the industry, especially smaller funds that maybe haven't, hired, the most, experienced accountants, are going to need to be really mindful of in the coming years.
Yeah, absolutely. That conversation reminds me of a podcast interview that I did with Kirk Walton a few weeks ago. We talked about some of the filing issues where QOZBs were filing Form 8996 erroneously. And then you got into a situation where the IRS considers that some QOF investments were made into other QOFs. It created kind of a whole mess there. And I don't know if there's been a clear way to unwind from that yet, but anyways, I'll make sure I link to that episode in the show notes for today's episode if anybody wants to go down that rabbit hole a little bit further. But certainly a lot of speculation regarding the legislation. I think by and large, the industry wants this legislation to pass. The industry is ready for additional reporting and transparency requirements. We consider it a good thing on the whole, and we're certainly looking forward to having the provision, the opportunity zone tax policy extended for an additional 2 years, reopening up some of the 5 and 7 year, or I guess now it's going to be a 6-year window for the 10 and 15% basis step ups. If you don't know what I'm talking about, this is going over your head. I've got a recap of the legislation. I'll be sure to link to that on the show notes page for today's episode as well. You can find those at opportunitydb.com/podcast. When it passes, I think is a matter of speculation. I'm still expecting it to pass. I've been on the record since April telling people I think it's going to pass before the end of this year, sometime in December after the election, but before the end of the year, probably as part of a larger tax extenders bill. There was one panelist who was a little bit more pessimistic about that view, and he thinks it likely might undergo some more changes, and maybe it'll eventually get passed in 2023. Hopefully it passes one way or another sooner or later. Brett, I didn't want to belabor the talking points on the legislation too much longer. I wanted to talk about macroeconomic trends, but I don't know if you had any final words about the legislation before we move along.
Yeah, sure. I mean, I think, just to kind of add to what you were saying, Jimmy, I think ideally it would pass at the end of the year. I think we've seen a lot of, fourth quarter activity the last 3 years. I think it would really help to booster activity at the end of 2022, especially if there is that, 15% step up available for investors this year. That was a huge windfall for folks the last few years. And then, I guess the fund to funds concept is another one that I think would really help the industry. I know there's a lot of opportunity funds out there that would love to invest in smaller funds, and there's also smaller funds out there that may struggle to find deals. They've set things up, but if they could be involved in a larger fund, that I think that'll help only increase activity.
Oh yeah, absolutely. Yeah, I can appreciate if you are a smaller fund, maybe you've got $1 million or less than that even in gain that you rolled over into your own qualified opportunity fund. And now you're kind of running up against your deadlines for finding projects to invest in. Might be easier if you could just simply stroke a check to a different fund and have your QOF invest directly in another QOF. That would certainly simplify that for those types of individuals and would help at the end of the day, drive more capital investment into these opportunity zones.
Yeah, no doubt. I mean, it's a rather artificial impediment that was instituted at the outset. And I think the good news about this too, Jimmy, is that this is bipartisan, bicameral. I venture to say that this incentive has been from the outset. So I think it's one more reason why both sides are working together to try to make this work. And I think going into a recession, that's going to be even more important, that we want to continue to encourage folks to go out there and do deals.
Yeah. Well, let's talk about that recession. When you and I were speaking at the OZ Expo a few weeks back, we were talking about a future podcast episode we could do, which we're recording today now, finally, Brett. And one of the topics that you wanted to touch on was the recession's impact on opportunity zones. It looked like we were in a recession. It kind of would depend on who you ask. I don't think the NEBR officially ever stated that we were in a recession for the second half of this year, even though we did experience GDP declines in both Q1 and Q2. Very coincidentally, though, just this morning, the Commerce Department came out with their most recent GDP figures, and it actually surprised me how good they were. They showed a 2.6% annual growth rate in the third quarter, which reversed those declines in Q1 and Q2. So We did experience 2 consecutive quarters of GDP decline, which is the technical definition of a recession. Depending on who you asked, I think we were in a recession, it looked like, although
Sure.
there were some conflicting economic data like strong job market and that could run counter to that. But in any case, if we experience GDP growth in Q3, technically we're out of a recession as of today, I believe. But that said, I think maybe a recession is on the horizon. Consumer sentiment is still very low. Inflation is running very high, despite a strong job market, though. That said, if we are in a recession or headed toward a recession, what would a recession's impact be on the opportunities on marketplace in your mind?
Yeah, well, I mean, it's a fascinating topic, whether or not we're in a recession, whether we've been in a recession, whether we'll be in a recession. But I think what's clear is there are recessionary trends happening, and they're already affecting fund sponsors, fund investors, developers, and pretty much everyone in the industry. I think it's safe to say that over the last 3 or 4 years, the vast majority of the projects that are getting done are real estate projects, for better or for worse. And there's been quite a lot of activity, of course, in the multifamily and industrial sectors. And I think even before we were in a recession, the the inflationary trends were happening with the supply chain shortages, coming out of COVID, with the long delays of materials sitting dockside on the West Coast last year. We've been seeing the effects of that over the last year on a lot of deals. The cost of lumber more than quadrupled at one point. We're seeing the cost of other materials, concrete, windows, appliances, just about everything steel has been affected by that over the last year. And that's costing sponsors and developers and their underlying investors.
And not just materials costs, but labor costs have
Oh
gone
yeah,
up too, right?
no doubt about that.
Yeah.
And there's been a labor shortage. So it really has less to do with the recession than it does with just sort of larger trends that are outside of our control and how that's impacting deals. And I think there's no doubt, inflation has become a major issue for the first time, maybe in our adult lives, Jimmy. I mean, I haven't thought about inflation since I was in grade school in the 80s. And I think we're seeing it for the first time, what life might look like when interest rates creep up. I mean, we've been living in this world, maybe artificially, for 10 plus years with these really low advantageous interest rates, and it's created this entire economy, if you will. So what I'm seeing, working with clients, talking with people, is that they've got to get a lot more creative than they did even just a few months ago. Finding construction debt is becoming increasingly difficult. The amount of leverage that can be brought into a deal is significantly less than it was a year ago. I mean, we were seeing deals 70-75% leveraged, and now I'm hearing 50 to 55 might be more realistic, at least during the construction term. And of course, you're probably more familiar with where rates are and where rates are going. But my concern too is that I think it's a pretty much a foregone conclusion that the Fed is going to continue to increase rates at least one or two more times.
Yeah. They've already raised rates quite a bit. I think it's been 3 consecutive meetings that they've raised rates by 75 basis points. They have another meeting coming up soon, and that may lead to another 75 basis point increase. This episode will probably air after that meeting, actually, I'm realizing now. But they have really put a lot of upward pressure on rates by raising the federal rate quite dramatically in a very short period of time. So we've now got, if you put a pro forma together for an opportunity zone deal in 2020 or 2021, maybe you were expecting to get a construction loan at, a low rate, and now suddenly it's much higher. Maybe it's creeping up to 6% or more. And if you were planning on doing a permanent debt refinancing after the asset is stabilized and you were expecting a 3 or 4% rate, that's suddenly no longer the case. What impact does that have on deals, or what impact has that already had on deals, these rate increases? And also, Brett, what will further increases do to 2023 new construction deals in your view?
Yeah, I guess, in my experience and my exposure to that is that it's making it a lot harder to get deals done already. And you're right. A year ago, you could probably get a construction loan at 3 or 3.5%, and now you're looking at 6 or more. What happens when the Fed raised the rates 2 more times? We're looking at potentially 8% rates in 2023, and my fear is that deals just won't get done. It's almost impossible to pencil a deal, in this current program, with the way deals are modeled. I think what it does is it puts a lot of pressure on sponsors to go out and raise money. You just gotta be under less leveraged, and then you're gonna have to bring in more investors, or bring in bigger investors, but that's gonna cost you too. And I think so you sort of have to struggle with, well, what happens to yields, and how do you attract investors when you're under leveraged, so to speak? I think that's going to be, the challenge going into 2023. I don't know how it affects institutional money. I guess I'm hopeful that we'll continue to see more and more high net worth individuals, come into this space and play. Ideally, there's still going to be a wave of investors here, at the end of this quarter, as there has been for the last several years. We always see an uptick in fourth quarter activity. I get the sense that there's been somewhat of a stock sale off over the summer. So you've got 180 days from the time that those people were selling assets to potentially invest in a new QOF, and then maybe there's more people out there that sold real estate or businesses. Maybe people in the 1031 space that just are having a hard time finding replacement properties. Maybe we see more of them too coming to play in this space. So I guess the bright side is that this incentive has continued to attract more and more equity. I think you're well aware of the numbers that Novogradac keeps, and the trends have continued to improve each quarter, the number of dollars invested in these funds. And I'm hopeful with maybe the proposed legislation passing, and other incentives, especially that 15% step up, that might attract more and more people into this space, that maybe helps us carry through this 6 to 12 month dip, whatever you want to call it, if it's a recession or just reaction to inflation.
Yeah. So the marketplace had some, and I guess actually just in general, the real estate market, equities markets had tailwinds at their backs for the last decade or more, really. And now we're experiencing some headwinds here. Opportunity zones are becoming, I guess, more and more prevalent in the minds of investors. Every day that goes by, more and more investors and advisors become more familiar and aware of the program. But there are some headwinds that we're facing now with these macroeconomic conditions and the stock market drawdown, as you mentioned. Just to put a little bow on this and talk about Novogradac's numbers for a moment, they came out with their Q3 numbers just about a week or so ago from when we're recording this episode. Their Q2 to Q3 actually was roughly flat, I guess, maybe slightly up, maybe slightly down, depending on if you're calculating on aggregate or on a per fund basis. But Q3 year over year from the same period in the previous year was actually down slightly. I don't know if that's too alarming. On the one hand, there is a lot more uncertainty in the market than there was a year ago. And I do think you're absolutely correct. Q4 is always the strongest quarter for opportunity zone investment. It has been since the first numbers started coming in 2019.
Mm-hmm.
I'm expecting that we'll have a strong Q4, particularly if I think you're right about Section 1031 exchanges. There are just fewer transactions happening. Transaction volume for real estate has declined quite a bit this year with interest rates rising and it just being harder to get a deal done. So I hope a lot of that money finds new home in opportunity zones. And I don't know if we're going to see equities investors, stock market investors come in more or not. I guess we'll find out over the next several weeks and months here. But I can kind of buy into that idea that maybe there was a big sell-off in the summer, and I guess 180 days is coming up pretty quick for some of those investors. So I think
it's a bit speculative, but I guess the other thing that maybe is encouraging is I think there's more and more people out there that are tired of the 60-40 balance, stocks to bonds. And it's been historically difficult, even for high net worth people, maybe to find a real estate fund that they can invest in and trust and really understand. It's a different model. But I'm hearing more and more that maybe that 60-40 approach is is sort of going by the wayside, and that there might be some more room for the everyday high net worth folks to say, look, maybe we should park 10 to 20% of our investments into a real estate fund or a qualified opportunity fund.
Yeah, so now you're speaking my language, and we talk about this concept a lot on my other podcast, the Alternative Investment Podcast, at our sister site, altsdb.com, which covers the alternative asset classes more broadly than just OZs. And one of the stories we've been hearing this year and retelling this year has been that shift from 60-40 to more of a 50-30-20 model, 50 stocks, 30 bonds, and then 20 in alternative assets like non-liquid real estate, like non-liquid opportunity zone funds. And by the way, I say the 50-30-20 with a bit of a grain of salt. Those numbers are meant more conceptually than as precise asset allocations. You need to talk with your own financial advisor to determine what the best asset allocation is for you. But conceptually, I think that there's a trend there where a lot more investors and advisors in the retail non-institutional sector are considering alternative asset plays a lot more. And I think Opportunity Zone helps incentivize that trend and accelerates that trend quite a bit. And I'll actually just speak personally as an LP myself. I've done just that. I have shifted out of a 60-40 style portfolio and have invested into some Opportunity Zone funds and some other illiquid alternative assets myself over the past 18 to 24 months, as I saw the stock market hitting new highs and thought I was a little bit overexposed to stocks. I took some chips off the table and rebalanced my asset allocation a little bit there. So, Brett, I did want to move on and shift gears a little bit. And I know
before you do, Jimmy,
go ahead, Brett. Some final
I wouldn't
thoughts
mind
there,
just
sure.
You're just throwing a bone to you and your team too, because I think Opportunity DB and Osworks Group has really done a great job of getting this message out to folks that might otherwise be on the sidelines, that wouldn't otherwise be inclined to invest in a real estate fund, and certainly not a qualified opportunity fund. I mean, it's sort of a an old boys network still out there, but I think you and your folks have done a great job of getting the message out to more of the masses, and I hope that helps to continue to attract more and more investors to this space.
Well, sure. Yeah. One of our missions is to help democratize access to these types of asset classes or investment instruments, what have you, that typically have been only institutional. I think more and more access to these types of investments, real estate funds, or other types of alternative asset classes are becoming more for the mass affluent or for high net worth accredited investors, more the retail segment of the investor world, for sure. And we're happy to be doing what we're doing to try to get that message out and try to further democratize access to these types of investment products. And a lot of kudos goes to the fund sponsors out there as well for setting up these deals such that they are accessible by that type of investor. So let's move along now to talk about, you wanted to talk about, Brett, specific examples of good opportunity zone deals and bad opportunity zone deals. I don't know if I've heard, we didn't prep for this too much. I didn't hear any of the good or the bad. So maybe
Sure.
it's the good and the bad and the ugly. I'm not sure what you're going to give us here, but walk us through in this next segment here what you consider to be characteristic of a good deal or a bad deal.
Yeah, I would say, and again, I've played mostly in, the real estate sector over the last 3 or 4 years, since the incentive was instituted. And I would say that the best deals, the best clients that I work for are the ones that have a project in mind or have a group of projects in mind. They've got a plan. They know exactly where they're going with the money. They've studied the market, and they have a product or an asset class that's really going to take off. They've done market studies, and they time it well. So there's certainly luck and timing, but there's also just finding a really good site is a huge part of this. And one of the challenges, I think, really from the outset has been, even though there's 8,700 plus opportunity zones out there, very few of them have actually seen investment. And it's unfortunate, really, because of course the whole idea of the incentive is to encourage investment and development and expansion of low-income communities. But the fact is that money chases the best deals and the best sites. And so it's been extremely competitive to find good opportunities on sites. And I think it gets harder and harder each year. And so, the good ones were the ones that really did the research, or maybe got lucky early on. Maybe they even had a site that was already in a zone that was in their pipeline, and they just got lucky. It was icing on the cake for what was already going to pencil out as a good underwritten deal. And on the flip side, I think the bad deals are the ones, there's sponsors. I've seen a lot of groups that just sort of come together. Maybe they haven't, they've all done great things, throughout their careers, but they haven't necessarily been on a team together. They come together, they've got all these great ideas, pie in the sky kind of approach, but they don't really know what they're doing. And I've seen, a handful of those where they have great intentions. They know what they want to do, but they haven't really pinned down a site, and they sort of take that for granted, that there's going to be a good site and that their model's going to work. But the blind pool approach doesn't seem to be terribly effective, frankly. Most of the successful clients that I've worked with have either done single asset funds, or they've had, a fund with 2 or 3 or no more than 4, deals in the pipeline. But they have a really good idea of exactly what they're going to do. I can say one class that's really knocked it out of the park has been, student housing, especially student housing on a campus that's in an opportunity zone. And if you've got an experienced developer that's sort of been in that class and understands that market, and has the relationships on the ground, which contractors to work with, which subs to work with, how to get things done at the city or county level, and then execute and build, a project in, under 16 to 18 months, and then be ready to launch when the new class comes in the fall. And what a great way to stabilize in less than 2 months. I built this project, it's brand new. All the rich kids on campus want to live there. It may not be exactly what the framers had in mind, but it's been a phenomenal model for investors and sponsors out there. And I think in general, good multifamily deals have just killed it. And I think there's a lot of really good multifamily developers out there that understand where they need to be. We hear about the smile of the United States, starting from the Carolinas down through Georgia, Florida, up through Texas, and then into the Southwest, and then up the coast. And that's where we're seeing the most successful deals. I think everybody's chasing a lot of the same sites in that region. And unfortunately, I think that the other area that I've seen this project struggle has been, just been in rural areas. It's been harder for sponsors in outside of the major metros to attract capital. I think that's always been the case, but I've noticed that the groups that have a local network of people that sort of buy into their product or buy into their business model, they're gonna succeed. It's gonna be a smaller knit group, but if I'm out, on the res, so to speak, sort of far from a metro, and I don't have a good network of potential, investors to tap into, it's going to be really difficult to not only raise money but to get good leverage.
Sure, and that makes sense. I mean, those are just kind of larger problems that the opportunity zone policy incentive can't fix all by itself,
No,
right?
no.
I want to kind of hone in on one thing you said about opportunity zone funding going to housing for rich college kids. I wanted to just kind of point out one fact about the OZ reform legislation. So a lot of opportunity zones got placed in or adjacent to college campuses where most of the residents are students, and students are technically low income, even if they do come from wealthy families and have access to plenty of money. So I think that may have been an oversight initially by the legislation and the people who slated the opportunity zones across the country. But the OZ reform legislation, if I understand it correctly, would disqualify a lot of those types of zones and instead use a different metric to get at whether or not the census tracts are low income. So I would say if you are interested in doing student housing in some of these technically low income, but typically higher, wealthier students, now might be your last chance, because the funds that do make the investments prior to the legislation getting passed will get grandfathered in. But I don't know if that's a good long-term trend to hold on to if the reform legislation passes. Do I have that right, Brett? Have you heard anything like that or anything different?
Yeah, no, I mean, I think that's sort of the third rail of that legislation, that we haven't really talked about yet here today, but we did talk about on the panel at the expo. And yeah, I think that's going to be really controversial, Jimmy. That process for decertifying opportunity zones, and of course, one of the concerns I think out there is that the original zones were designated based on 2010 census tract data. Of course, a lot can change in 10, 12 years. So I think, going forward, the new certified or decertified zones would certainly be based on 2020 census data, but we're always going to have this problem. I mean, the census data is stale as soon as it's collected. And with each passing year, there's demographic changes, there's population shifts. And so, I think, that's going to be a very political and challenging process. There's certainly, tracks in certain states that were maybe handpicked or designated by the governors and their staff that they really wanted to incubate more development in certain areas. And sure, I guess the problem now is, well, what if the the poverty rate is or the income is 130% greater than the regular area median income? They're going to be on the chopping block. I have not heard anything that campuses are being targeted in particular.
Well, the one thing is, and this is, I didn't want to get too technical, but I guess I will for a minute here.
Sure.
They're redefining the metric that they're using. So previously they were using median household income to get at whether or not a census tract qualified as low income. And now they're going to use a metric called family household income, I think it is. I'll clarify this in the show notes and I'll have links to this, but family household income is going to somehow get around the student population. So this, if you've got a large pocket of students in a particular census tract, they will no longer count as low income going forward. That's my understanding, at least.
Yeah, no, I mean, that's a good point, Jimmy. I'm looking at it now, and you're right. It would disqualify OZs if the median family income exceeds 130% of national median family income. So it's
Right.
a
So previously they were
really,
using median household income.
yeah, that word changes a lot.
It does change a lot. Yeah.
Yeah, but I think it's also a concern for, maybe areas that are gentrifying in certain, metros that have
Oh yeah,
seen a
and
lot of,
absolutely not
yeah,
only that, but the data is getting updated. It's much fresher than it was when the
yeah.
OZs got slated originally, for sure.
Yeah, I guess, I mean, the good news is if I've already, handpicked a site and I got lucky enough to be in one of those zones, and I've, done my offering, I've even taken down the land, or I've at least spent $250,000, then I'm pretty well grandfathered in, I think, under the current proposed legislation. So,
Yes.
maybe I can say, I got onto the block and no one else will, so maybe that's an even bigger advantage.
Yeah, it may be. It may be. And again, if you are going to get into one of these zones that might be on the chopping block,
Mhm,
the time is now or never potentially. Because if this legislation gets passed in the next few weeks or
mhm.
months, you'll be grandfathered in if you got in time. But otherwise, it won't be available going forward. And then one other issue with the decertifying
Mm.
is, and this is a little bit technical as well, but I think our viewers and our listeners should know, is that we are using the 2010 physical geographic boundaries of these census tracts as opportunity zones, but the new data doesn't use those same physical boundaries. It uses the new 2020 map. And
Right.
oftentimes the physical shape of the opportunity zones in 2010 is no longer the shape in 2020. So the 2020 data for any one particular zone may not really map into that zone one to one, if that makes sense. So it's going to be very difficult to actually crunch the numbers on which of these tracts, in fact, is no longer eligible.
Yeah, and again, my concern there too is I think you're going to see a lot of lobbying. If this legislation passes with this provision in it, at the state level and at the local level, and even at the national level, you know, there's gonna be pushback when certain tracks are decertified, and it's unfortunate. I mean, there's no easy way to do this. Um, I think 4 or 5 years ago, when the original census tracts were designated, people really weren't paying that much attention. So
Mm-hmm.
it gave governors and their staff a ton of discretion, and anyone at the local level that was lobbying then probably got their way, so to speak.
Mm-hmm.
I've seen
Yeah, quite
examples of
possibly.
that where,
Depending on which state you're in, for sure. But now the
yeah,
governors will have a chance to replace any early disqualified census tracts. So that'll at least be another bite at the apple, so to
yeah,
speak.
but also an inherently political process.
And of course, it will be an inherently political process as well, because they will have, um, several dozens, if not hundreds, of zones to choose from, depending on which state they're in.
Yeah,
And
for
you'll only
sure.
get to
And I think
select a handful that get to be newly designated as opportunity zones. It will be an interesting process to watch unfold, for sure.
I agree. Yeah.
So, well, Brett, I think we're kind of running out of time here. Unfortunately, we spent a lot of time talking about macroeconomic conditions and the legislation. Just to kind of wrap up our conversation now, any high level thoughts from you on how we can get more investors into opportunity zones later this year and heading into 2023? How do we turn the tide a little bit and get more investors into OZs?
Yeah, that's the $10 million question, I guess. I think just continue to do what we're doing, Jimmy. I think getting the message out, going on the road, talking to folks, sort of breaking the mold, if you will. I still think there's quite a few folks out there that are ambivalent, or just a little gun shy about investing in a real estate fund. They may not understand it. It takes a lot of trust in the sponsor, and so I think one of the biggest challenges of this program too is that I've got to park my money for 10 years. And, if I go to any other real estate fund out there, I'm only likely to do so for 3 to 5 or 7. So I think, tapping into those investors out there that maybe are looking to be a little more patient, and maybe going into this, downward spiraling economy, recession, whatever you want to call it, maybe there's going to be more opportunities to find those people that just, they don't know what to do, because the stock market is not a great market to invest in as much nowadays.
Yeah, certainly is. It certainly hasn't been this year. It's down, I think, about 25% through Q3, and it's been very volatile here in Q4 so far as well. So it has been tough for stock market investors, that's for sure. Well, hey, Brett, I wanted to thank you again for coming on the show today. It's been great to get your insights. If we have any listeners or viewers out there today who are interested in learning more about you and the good work that your law firm Jennings Straus provides, where can they go to learn more and to get in touch?
Sure. They can reach me at, bsiglin@jsslaw.com. Check out our website, and feel free to reach out. I'll just give my phone number, 602-262-5842. And really appreciate this opportunity again to be on your show, Jimmy. I love what you're doing, and let's keep it going.
Absolutely, Brett. And again, for our listeners and viewers out there today, I will, of course, have show notes available for today's episode at opportunitydb.com/podcast. And there I will have links to all of the resources and the contact information for Brett Siglin. Be sure to subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes from the Opportunity Zones podcast. Brett, again, been a pleasure. Thanks so much.
Thank you.